So, welcome, good people. Welcome. This is a KASNEB ATD May 2021 paper. ATD May 2021 paper, Introduction to Financial Accounting. Introduction to Financial Accounting, May 2021 paper. We'll go through all the questions and we'll start with question 1. The following trial balance was extracted from the books of Farida Enterprises as at 30th September 2020. So we have capital account, trade receivables and payables, purchases and sales, returns inwards and outwards, discount allowed and received, inventories, rates and insurance, allowance for doubtful debts, rent received, bad debts, written off, staff salaries and wages, carriage inwards, carriage outwards, electricity and water, motor vehicles at cost, equipment at cost, accumulated depreciation, bank balance. Additional information: inventory as of 30 September amounted to 3.6. Insurance paid in advance 500,000. Electricity outstanding 300,000. Rent due but not received amounted to 200,000. Allowances for doubtful debts decreased by 100,000. During the year, goods estimated 2 million were stolen and insurance accepted claim of 1 million. Depreciation to be provided on motor vehicle and equipment. And we are expected to come up with a statement of profit or loss for the year ended 30 September 2020 and a statement of financial position as at 30 September 2020. So that will give you the 20 marks. The 20 marks that you so badly require in this paper. You know, you have to pass it to go to the next stage. So the examiner feels 20 marks will be enough for you. We are just trying to create some space here for this question that is before us. Okay. So normally the best way to go about such like questions, number 1, is to work out on the additional information. Work out the additional information, because sometimes there's a tendency of students forgetting. You forget some items, you don't capture some items, and that can lead you to, to start those errors to start deleting, and it's not allowed in accounting to keep on deleting. In fact, should not appear anywhere, erasing. And so the best way to start is always come up to work on the additional information, so that when you start making the final books of accounts, it just flows. But if you are convinced that you can do this well without forgetting any item, then you might as well just take it head on. So for me, I will take it head on, but I will advise, if you are not so sure of yourself, the best is to go through the additional information first, because this can be quite tricky and you can leave out some items if you are not so keen. Okay. So having said that, I will just go through the additional information so that I familiarize myself with everything that is on the additional information. So I know I have closing inventory, which is here. I know I have prepaid insurance, and prepaid insurance affects both P&L and the financial statement. I also know I have outstanding electricity, 300,000. Rent due but not received amounted to 200,000. Rent due is under the incomes and income received and gains and incomes received. It's in the P&L and it's also found in the financial statement. Allowance for doubtful debts to be decreased by 100,000. Yes. So anytime I deal with the allowance for doubtful debts, I know there is a figure here, 100,000, and this one affects both the P&L and the balance sheet. During the year, goods estimated 2 million were stolen and the insurance accepted claim for 1 million. Yeah, it affects both P&L and the balance sheet. We'll see how it affects depreciation. Yes, that affects both P&L and balance sheet. So at least I'm familiar with everything that is here. So anytime I come across something that was captured in the additional information, I should be able to remember and come and deal with it. But you can as well start with additional information, work them out, so that you just run through the whole thing when the right time comes for you to start preparing the final books of accounts. So I think we are ready to go. And so I'll go, because of my approach, I'll go straight to this. And this is Farida Enterprises, 30th September 2020. Farida Enterprises, 30th September 2020. I'll come here and say Farida Enterprises, Farida Enterprises, income statement for the year ended, 30th September 2020, like that. Then I underline just to show that it's a heading, like that. Then, as usual, I'll come up with the 3 columns, and I will choose to restrict the zeros. I think even the question has restricted the zeros, so the 3 columns always good way to look at it. And I'll start with the trading account. The trading account, it's obvious. Start with the sales, and I've seen we have sales here. Now, when the examiner puts purchases and sales together in the same line, can be quite tricky, especially if you don't know which is which. So always remember, sales is a credit account and the purchases is a debit account. Sales is a credit account, purchases is a debit account. So in this case, sales will be 36,600. That's 6,600. And there was, now this is the power of remembering now. You must exercise it. You remember there was return inwards and return outwards. So in fact, it is here. So return inwards and return outwards. One of them is sales have come back. The other one is purchases have gone back. So which is which? Return inwards, what you have sold to the customers. Return inwards, you have sold to the customers, and then the customers have returned the goods back to you. Then purchases, these are goods that you bought from the suppliers, and then you supplied back to you returned back to the suppliers. So return inwards, customers have returned back to you the sales which have come back, and then purchases which have gone back are returns outwards. It's you who has returned them to the suppliers, and that's why we call them return outwards. So in this case, return inwards will be on the debit side because they are coming back, and then return outwards will be on the credit side. No, we are reducing on the purchases. So don't forget that return inwards will be on the debit side, and then return outwards is a credit account. So now, having said that, our sales is 36,600, and because it has some workings, we have to factor in the returns. We'll put it in the inner column, and then we have now the returns inwards, what the customers return back to us after we have sold them. This will now make it 36,000 like that. So 36,000. So return inwards 600. That is 36,000. So we are done with the sales. And let's see if there's anything else that affects the sales. This will not affect. Okay. So let's move to the cost of goods sold. So we come here, we say cost of sales. And cost of sales, we have opening stock. So opening stock. Cost of sales, we have opening stock. So let's take opening stock. Opening stock is opening stock. Inventory, this is the opening stock. You can see opening stock is 3,000. So we simply come here and have 3,000 as our opening stock. Then we add purchases. And purchases, since we are already sure that it has some workings, it will go to the innermost column. So purchases 24,400. So you take it to the innermost column because there is some workings on it. 24,400. and the workings on it are returns outwards. We bought and we returned these goods outwards to the suppliers. So return outwards, the figure is 400. So 400 return outwards, the figure is 400. And there's also another cost. We saw carriage inwards and carriage outwards. That is very important. Carriage inwards. Inwards are the costs that you incur when you are, when you are purchasing the goods. So that one is normally included in the cost of goods, as opposed to carriage outwards. Carriage outwards are the costs when you are supplying goods to the customer. That one is normally considered an expense. So carriage inwards, since carriage inwards is considered a cost to the goods, we will always add it here on the, so it forms part of the cost. We add it to the purchases, so it forms part of the cost of goods sold. So carriage inwards is 200, so we'll come and bring it here. The cost that we incur to transport the goods into the organization, so that is 200, so we'll bring it there. And then do we have any other thing? Now there is something here. During the year, goods estimated 2 million was stolen, and the insurance accepted claim they were stolen. So I think we'll tackle that later. It may not feature here. So let's move on. I think there's nothing else. There's nothing else. So you have to make sure that there's nothing else. If there's nothing else, so we have these as our purchases. So the total will be 24,200, if I'm not wrong. 24,200, and then we less now the closing inventory. Closing inventory, which is 3,600. Remember to do away with the zeros. We chose to restrict the zeros, so it should always be like that. So this will give us 3,000 plus 24,200 minus 3,600. This gives us 23,600. So we'll have 23,600, and this will come here, 23,600. So that gives us, so this is 23,600 minus 36,000. That gives us 12,400. So we have 12,400 here as our what? Gross profit. So this becomes our gross profit. Then we know from now the gross profit, we need to add incomes and gains. Now we need to add incomes and gains. So let's go for any income and gain here. Discount received, of course, this again. Discount received. Now discount received is supposed to be on the credit side. All expenses are on the debit side. Incomes and gains are on the credit side. So if you are given two items like this, discount received is the one on the credit side. So discount received 400. Discount received 400. So let's add all of them here. Looks like there are many because I've seen there's also rent received. So we put them in the inner column, and then the total will go to the outer column. Okay, so discount received, we've already taken that one. Rates and insurance allowance for doubtful debts. Rent received, this one is 1,000. Rent received 1,000. We'll come back to that allowance for the bad debts. So rent received, this one is quite straightforward. Now, there was something about this rent received. Remember? That's why I said you need to be very careful. As at 30th September, electricity outstanding amount, there was something? Yeah. While rent due but not received amounted to 200,000. This is rent due but not received. We are the ones supposed to receive. So what we received is 1,000. But what we have not received is 200. Remember the zeros are restricted. So it means the total rent we are supposed to receive is 1,200. So rent received, and because there's some workings, let's have it here. And then rent due but not received is how much? 200. So the total becomes 1,200. I hope you're seeing how I'm organizing my work. Then we go now, we have already tackled this. Now we move to, that was the rent received. So then there's allowance for bad and doubtful debts. Remember, for allowance for bad and doubtful debts, how do we treat this? An increase is normally debited and a decrease is credited. Decrease is credited. Decrease is treated as a gain. An increase is treated as a loss. So an increase debit P and L, a decrease you credit P and L. So an increase is always debited, a decrease is credited. So this statement is very clear. Allowance for doubtful is to be decreased by 100,000. So these are decreased. There's even no need of going back to workings now. Let's just pick it as it is. Decrease in allowance for bad and doubtful debts, for B and D debts. How much is it? 100. It's very straightforward. There's no need of, Okay. So let's move on. Rent received, bad debts written off. I'm trying to get any other gain. So we don't have any there. We don't have any here. Let me see. During the year, goods estimated that, I think this one, and the insurance accepted claim for 1 million. Instead of showing this as other incomes, I think we'll just offset and then talk over the loss. So this one will just treat it under loss and expenses. That's why I will take it. So let's not, I think we'll not approach it from the side of other incomes. Otherwise, we'll have recorded 1,000 as other incomes. That is receipt from insurance, and then we come and record a loss of 2,000 as stolen goods. But we'll just offset. All of them are correct. You can choose to put this 1,000 under the other incomes, and then you show the 2 million, which in our case will be 2,000 because of the restricted zeros, under the expenses and losses. But we'll offset and show loss 1 million because, I mean, he lost 2 million and he was compensated 1 million, so the loss is 1 million. Okay, so let's leave that one out. We will just offset. So if that is the case, if we choose to go with that approach, then this will be 1.5. 1.5. This is 1. Is it 1.5 really? 1.6, 1.7. It's 1.7. You just add this 1,600, 1,700. So then we come here. We have now the expenses and losses. Expenses and losses. Expenses and losses. So we need to capture all the expenses and losses. Let's start with our first one. Our first one is the first expense loss is discount allowed. Discount allowed is 300. So discount allowed 300. That's how we go about it. Just pick them as they are. There was no one working on discount allowed. So discount allowed 300. Pick it. Then this is inventory. Rates and insurance. Rates and insurance is 3,000. But there was something about rates and insurance. Yeah, we have them here. So insurance, yeah, there's something on insurance. Good. It's insurance. So insurance paid in advance amounted to 500,000. In advance means that it's not a cost for this year, it's for the following year. So we are supposed to do away with it. We are supposed to less that from what was paid. It means it was paid in excess up to next year. Are we interested in the next year expenses? Really? No. So we get rid of it so that we retain this year's expenses. So rates and insurance, the figure was 3,000, and then prepaid. This is prepaid, paid in advance, 500. So I'll simply come here and say rates and insurance. Rates and insurance. How much? 3,000, because there is some workings. And then we say prepaid insurance. Prepaid insurance, 500. You less from this, so we have 2,500 here. That's how we go about it. There's no need for saying less or something. So long as you put it in brackets, it shows 3,000 minus 25 is 2, minus 500 is 2,500. Then we go to the next one. We are already done with this. We were only interested in an increase or a decrease, and we have already captured it's a decrease. So we go to the next one, rent received, we've captured that. Bad debts written off is 600. So come here, bad debts written off, these are a loss to the business. Bad debts written off, 600. So definitely it will feature here. Bad debts written off, 600. Next, staff salaries and wages, 4,000. Staff salaries and wages. Was there anything on staff salaries and wages? Staff salaries and wages, nothing. So we pick it as it is. Staff salaries and wages. Staff salaries and wages, 4,000. Next, we have carriage inwards. We've already captured that. Carriage outwards, 700. So capture that. Carriage outwards, 700. Carriage outwards, 700. Next, electricity and water, 1,500. Electricity and water, 1,500. And we have an outstanding amounting to 300. An outstanding amounting to 300. That means it was supposed to be paid this year, but it has not been paid. So it's part of the expenses for this year. So electricity and water, 1,500, and then we'll have to add this because it's part of this year's expenses, which was not paid. So we'll come here and say electricity and expenses. Electricity and expenses. How much? 1,500. Because of the workings, we'll have to outstanding electricity expenses. Outstanding electricity expenses was 300 if I'm not wrong. So this makes it 1,800. So you can see we are showing the workings and we're also showing the totals. Very clear. Our work is very well explained. Anybody saying it will understand. Then motor vehicle at cost, 4,800. This is a balance sheet item. Equipment at cost, 2,000. It's a balance sheet item. Accumulated depreciation, all of them are balance sheet items. Bank balance, balance sheet item. So we are done with this. Inventory, this one we used. We have captured. Electricity we have captured. Rent due we've captured. Allowance for doubtful debts we've captured. During the year, goods estimated 2 million was stolen, and the insurance accepted claim for 1 million. So here the loss is 1 million. So we'll just talk of loss on theft of goods. Loss on theft of goods, and put the, we are going to just work out this 2,000 minus 1,000. Basically what the loss was 2,000, but the insurance company compensated 1,000. So we are going to have a loss of 1,000. We've chosen to set off. Otherwise, you could also have it under the incomes, have 1,000 there, and then show the theft on the debit side 2,000. You'll still have the net effect of 1,000. So how you go about it, that's your choice. So then, where are we now? We've captured that one. Depreciation now. Let's go to depreciation. Depreciation is to be provided on cost as follows. On cost. On cost means we are going to, it's the straight line method. So we are not going to factor in the accumulated depreciation. So this is 25%, will be 25% of 4,800. So 25% of 4,800. It's simply 4,800 divided by 4. So for those who 0.25 times 4,800, that's how we go about it. This gives us 1,200. So 1,200, 1,200. So this is depreciation. And we have two depreciations. The first one is depreciation for motor vehicle, then the second one equipment. So depreciation, motor vehicle, and then equipment. You might want to also use to, you can choose to do it from there, and then the total will take it to the middle column. 20% of, this one is 20% of what? Remember, it's also on cost, so 20% of 2,000. So yes, it's 400. 20% of 2,000 is 400. That is 20 over, sorry for that. 20%, that will be 20 over 100 times 2,000. This gives you 400. That's how we go about it. So so that is 400, which makes it now 400, which makes it 1,600 for depreciation. Okay, let's go back, pick anything else. Depreciation we have captured. Is there anything we have left? Remember, if we leave anything out and we were supposed to capture, that is the start of problems. And this question will not balance if we leave out anything which we were supposed to capture. So you need to be very keen, very keen. I hope we have captured everything. So let's just add what we have here. 300 plus 25 plus 600 plus 4,000 plus 700 plus 1,800 plus 1,000 plus 1,600. Hope I've not left anything out. That gives me 12,500. 12,500. Because these are expenses, we less from this. So we are going to have 12,400. 12,400 plus 1,700. Remember, those were other incomes. This plus this minus 12,500. 12,500. What do we have? 1,600. So that becomes our net profit. Net profit. So net profit is 1,600. So having said that, I think this will now mark the end of this first part. Already you are eligible for the 12 marks. So let's go for the 8 marks. And again, we start with the heading, Farida Enterprises. Farida Enterprises. And we'll say statement of income position. Statement of income position. Statement of financial position. Statement of financial position. That's what is expected of us, to come up with a statement of financial position, and it has to be as at ended, not for the year, as at 30th September 2020. Notice the difference. This is as at, the other one was for the year. Difference. So we'll start again. We'll start with the, those columns, our imaginary columns, and because we are dealing with we start with non-current assets. We have accumulated depreciation, have net book value, and we have book value. So we'll have here non-current assets. So we start with the non-current assets, and we already know what we have. We have motor vehicles and we have equipment. And let's see if we have. And I think I can still remember some of these costs. This was 4,800 and this one was 2,000. Let's just confirm what I'm saying. Motor vehicle, 4,800. Yeah, motor vehicle at cost 4,800, equipment at cost 2,000. Then we now get the accumulated depreciation. This one had, motor vehicle had depreciated by 1,200. Had depreciated by 1,200. That was accumulated before 1st October 2019. So what is the depreciation for this year? It will be 1,200 plus for this year, which is here, plus 1,200. So that makes it 2,400. So the net book value will be 48 minus 24, which will be 24. Then you do the same for the equipment. The accumulated depreciation for last year was 400 plus now depreciation for this year. Depreciation for this year is also 400, this one. So that makes it 400 plus 400 is 800. So we have now 2000 minus 800, 1200. So this gives us 3600. Unless if we had any other asset, current asset. Let's just check. Did we have any current asset like land and building, plant and machinery? There is no any other. So we leave it at that. So let's go to current assets. We now move to current assets. Current assets. Under current assets, we have inventory. I still remember the figure. I think it was 3600. Yeah, I think it was 3600. It's just here. Inventory 3600. There we go. Then let's just try to be systematic here a bit. Trade receivables 4000. Trade receivables is an asset. Assets are on the debit side. So trade receivables 4000. So trade receivables 4000. Trade receivables 4000. Next. We are now interested in current assets. Bank balance 5100. Bank balance 5100. Bank balance 5100. Then there is this. Now we are done with the first part. There is this inventory we've already captured. So number 2, there's this prepaid insurance we paid for the following year. So it's an asset to us. Prepaid insurance 500. So we have to factor in here as an asset. We have not used it yet. Prepaid insurance 500 shillings. Next. Next. Electricity outstanding amounted to 300. That one is a liability. Rent due but not received. Rent due but not received. Rent due but not received. We are supposed to have received but we've not received. So the other guy is holding it on our behalf. 200. So rent received. This is an asset. So rent received. Rent due. Rent due. So this is accrued rent income. Accrued in rent income. Let's just call it rent due. How much? 200. It becomes an asset because we are expecting that money. He's holding our money. Allowance for doubtful debts to be decreased. I think this one will put it under the liabilities. You can deduct it from the trade receivables, but let's just put it under the current liabilities. That's the best practice. During the year, goods estimated 2 million was stolen and insurance accepted claim for 1 million. We have already captured this as a loss, but remember, goods estimated at 2 million was stolen and the insurance accepted claim for 1 million. So the loss of 1 million, this one will have to affect the inventory, the closing inventory. And actually what we are supposed to do is here we should have 3,600 less 1,000 to show that we have suffered a loss of 1,000 units inventory. So that here we'll now talk about 2,600. This 1,000 is a loss. The net we have set off. So the loss is 1,000. Of course, those goods were stolen. So they will have the effect of reducing the inventory. The closing inventory. So closing inventory will be less by 1,000, which was stolen. So that makes it 2,600. What else? I think we are done. We have captured everything. So let's just, as usual, get the totals again here. Let's get the totals. This is 26 plus 4,000 plus 51 plus 500 plus 200. That gives us 12,400. So 12,400. 400, like that. Then we go to current liabilities. So for current liabilities, now we have we start with the trade payables. I think it was quite obvious. Trade payables 1,600 on the credit side. Trade payables 1,600. So trade payables 1,600. Trade payables 1,600. Then we move to the next item. The next item is pick it again. We got the next item. Purchases, sales, return, discounts, rates and insurance, allowance for doubtful debts. Now, allowance for doubtful debts has been decreased by 100. Remember, it was 300, and then it has been decreased by 100. It was decreased by 100, and we actually showed that. This is the statement here, that allowance for doubtful debts is to be decreased by 100. So that means the new allowance for doubtful debts will be 200. It is the new allowance that you are going to capture in there. That is 300 minus 200. It was decreased from 300 to 200. So the allowance for bad and doubtful debts, allowance for B and D, is 200. 200. Not 300, not 100. So here we show, remember the other side we were interested in the reduction, and then here the new figure. So that is the difference. And then let's move on. Rent received, bad debts written off, staff salary, carriage invoice, so all this we go. Insurance paid in advance, that was an asset. Outstanding electricity 300 as a current liability. Outstanding electricity 300. So outstanding electricity, how much? 300. Good, we are on the right track. Let's see if there's anything else. So I think you are done. Let's get the totals. So this will be 1,600 plus 200, 1,800, that is 2,100. And because they are current liabilities, we just pick it like that, 2,100. So let's get the total. This will form our net capital employed. So net capital employed. So this will be 3,600 plus 12,400 minus 21. That gives us 13,900. So 13,900. This should be our net capital employed, 13,900. So then we come here and say financed by. Financed by. And financed by, now we have what? The capital. We go back, get the capital. The capital I think was here, 12,300. So capital 12,300. 12,300. Then we add the net profit. Net profit which we got, I think if I'm not wrong, it was 1,600. Yeah, 1,600. So add 1,600, and there we go. Looks like we were spot on. So this is 13,900. So that is how we go about it, and this also becomes our net capital employed. So that's the end of it. 13,939. It means we are correct. Everything done perfectly well. Thank you. That's our question 1. Let's meet in question 2.